Welcome to the Badger Podcast. This is Wasabi Boat Research. I'm talking today with Alex, the entrepreneur. Alex, what's going on?
Thank you for having me, Wasabi.
So today, our episode is called Better Know a Strategy. And this is going to be a deep dive onto all of the different yield farming strategies that Badger has made available to put your Bitcoin or various different flavors of Bitcoin to work. And Badger is on other chains besides Ethereum mainnet. But today's episode, we're just going to go over the Ethereum mainnet and kind of take a look under the hood at each one of these strategies and talk about what assets are going in, where they're being deposited, where the yield's coming from, and what is coming back out to the user. So, Alex, thanks for sitting down with me today.
Glad to do it. I think we owe it to our users to give them as much information as possible. So I'm very happy to go deep. And if you're listening and have a specific question for me or Wasabi, feel free to drop it in the chat. We'll address it.
All right. And so we are just going to, if you're on following along with us, you can either go to app.badger.com, or if you are watching this in a video that we later put out, we'll have diagrams of these strategies on the screen as you're watching along with us. But I think we're going to try to keep it so that you don't need to be also watching to have it make sense. So let's dive in. We've got a lot of work ahead of us.
Yeah, let's do it.
All right. So number one strategy, the Convex Imbtc slash Curve Sbtc LP pool. This is the pool that is trying to establish super deep liquidity for Imbtc interest-bearing Bitcoin, which is our flagship product, sort of tokenized Bitcoin flavor at Badger that we are sponsoring. So what's going on with this one? What is the kind of big picture flow of where the assets are going in this one?
Yeah, I'd say this is effectively closer to a staking vault than a actively managed vault. At the end of the day, we as Badger had an initiative called the Vested Escrow CVX, BVCVX, to get as much CVX as possible with the goal of influencing yields, with the goal of basically getting curve emissions. And so what we did is we launched a pool for Ibbtc, which is paired with the SBTC curve pool, which is basically a mixture of tokens for SBTC, Wbtc, and Mbtc. And what we did is we put this staking vault that effectively farms these rewards, these curve emissions, with the goal of providing deep liquidity for Bbtc. So anytime you see the curve keyword, it means that we're basically just staking this asset on curve. I think in this specific case, we're staking it on Convex because Convex is basically the staking aggregator for curve. And then from Convex, we're going to get a few emissions, and we just pass the emissions down to the end user in the specifics of a little bit of BV CVX, a little bit of CVX curve, BCVX curve. And then we also have a few fees. And lastly, in order to incentivize it, we also offer some Badger emissions on top of it. And so we make it a good offer by juicing the yields with some Badger, and then it's basically just a Convex staking vault for the Curve LP token.
And one thing to keep in mind here, the way the app is currently working now, the yields are going to change based on if your wallet is connected or not. So it's, I think, a good idea to connect to the app with a wallet. That's going to show you, especially if your wallet has some Badger in it, that's going to see what your current Badger boost level is, and it will update the APY to kind of accurately reflect what you're really getting, because a good amount of the yield that you're getting in this vault is comes from the Badger governance token that's coming on top of it.
Yeah, and ultimately the goal of this vault is to incentivize liquidity on Bbtc. So the DAO is subsidizing its usage through emissions. I'm happy to go into details on how you will get the token. But my biggest advice, though, is that when you go in the app, you can click on the specific vault, and you're gonna go into a beautiful page with charts and all details. And typically, for some reason, the most important information is actually in the bottom left. There's the link section, and you can click on Show More, and that's going to allow you to get access to the vault address, the strategy, and the underlying token. So once you figure out what the underlying token is, which in this case it's a Curve LP token, now you know you got to go on Curve and you got to provide liquidity in order to be able to join the vault.
Yeah, and the other thing that's unique about this vault is the zaps that are in place, right? So, what, as Alex mentioned, what's going on here is a user is taking IBBTC, they are wrapping it on Badger.com to wrapped IBBTC, then depositing it into Curve, and then taking that LP token and depositing it into Badger. Then Badger takes that and deposits it into Convex to harvest the rewards for that. So there's like a multi-step process that's going on here, and we've created zaps that make it easier for that kind of automate these transactions into one. So can you talk a little bit about how the zap works in this vault?
Yeah. Whenever you go on the Convex, on the IBBTC Curve LP vault, and you click deposit, you're going to be presented with a interface that looks a lot closer to the Curve interface, as in you can fill in specific ratios of different tokens. And that's because the you're actually not going to be interacting with the vault, but rather with a zap that is going to do the entire operation for you. So the zap is going to take your underlying tokens, could be IBBTC or any of the underlying for the SBTC curve token, which are Mbtc, Wbtc, or SBTC. And it's going to take this either basket of tokens or single token, and then it's going to provide liquidity on curve. And then from that liquidity is going to then deposit it in the vault. So that way, by going through the zap, you start with a tokenized Bitcoin, and you end up getting the vault shares without having to go to Curve and do the deposit yourself.
Got it. And I think maybe the last thing to mention on this vault is it's important to check the underlying Curve pool that you're going into. So that would be curve.fi /factory/60. And this will give you the data on this pool that you're going into. So the important thing to look at is the currency reserves in blue at the bottom. So there's a right now I'm looking at it. There's 57.7% wrapped IBBTC and 42.2% of the other LP token. So what that means is the pool is overweight IBBTC and underweight the other assets in the pool. So if you deposit the underweight assets, you're going to actually get a little bit of positive slippage. So it's basically like an arbitrage opportunity, right? Like, so you might want to reconsider like minting IBBTC because that's going to be negative. You're going to get the negative slippage on there, right? So you want to kind of, you're going to get a bonus if you deposit whatever asset is underweight in that pool.
Yeah, ultimately, Curve is trying to solve a very complicated problem, which is the pricing problem. How do you price an asset fairly? And in order to do that, anytime there's an abundance of one token, providing liquidity with the other token will provide you with a bonus in terms of the tokens, the LP tokens you're going to get back. You can view that as the equivalent of purchasing IBBTC or wrapped IBBTC through one of those alternative tokens. You're basically using your Wbtc to get some IBBTC because you're going to get a little bit more IBBTC at this time due to the imbalance. So, in general, as an advanced user, first of all, I would highly recommend that you understand the entire system and you do your own math before you commit to using any of these products. But ultimately, you if you were to go through the zap will do its best effort to provide you with a good price versus going on curve and doing your own math and making sure that that math ends up checking out. So personally, I would recommend always going on Curve, at least checking. And then once you understand what the mechanism is, you can decide whether 30 basis slippage is a deal breaker for you or not. And that way, you make an informed decision.
Yep. And again, it's going to make a big difference if you're depositing a larger amount of funds because it's, you're getting like 0.03 or some, small amount of slippage in one way or the other. It's not big, but it becomes material if you're depositing, I don't know, 10 BTC, 20 BTC, something larger.
100%. And my advice when it comes to providing, let's call it pool breaking liquidity, so too much liquidity, is that you want to calculate the ratios yourself. I'll tell you a quick story. I was aping into the Badger Wbtc Curve V2 pool. This is a little off topic, but basically I was using this new pool that Curve launched. And I basically didn't check the UI because the UI was saying provide tokens in equal amount. And I was like, well, it's going to do the math and it's going to provide, whatever $1,000 of Badger is and whatever $1,000 of BTC is. It's not going to provide the same amount, one BTC, one Badger, because it doesn't make any sense to a human being. But that's exactly what the UI does. So I ended up, aping in with like 3 times more Badger than Bitcoin, and obviously I got wrecked. So my advice is to really do the math for yourself into the liquidity you're going to provide, because if you do not, when you're using Curve, you're basically using a big brain tool that seems easy, but it is not. So you really want to do the math on the exact ratios you want. That way you're not going to get surprised later when you actually execute the trade.
Got it. So just to recap, the first set, Convex Ibbtc / Curve SBTC, you can deposit any of 4 types of tokenized Bitcoin, Ibbtc, RenBTC, Wbtc, or SBTC. It's going to put those into the Curve pool and deposit them on Convex, and you're going to be getting out a mixture of Badger locked Convex, CVX Badger, CVX CRV, and some underlying Curve LP fees plus Badger token emissions, which go up or down based on how much Badger you have in your wallet.
Yep. I would say that this is kind of the first vault we cover in this call. And ultimately, anytime we're going to be talking about Curve LP tokens, we're going to be saying very similar things. Ultimately, Convex of Finance has established itself as the leading yield aggregator for Curve. And so we decided very early to take a partnership first approach. And so most of our vaults, they use Curve LP underlying tokens, are going to be using Convex. So expect similar ideas. And that's why I highly recommend, again, to listen to this audio and then send us your questions, because most of the strategies are repeatable for different assets. But the strategies tend to be like there tends to be a dominant strategy that provides more yield than everything else, given given risk adjusted basis. So in this case, it's Convex, and so you'll hear a lot more about using Convex for some of our strategies.
All right. So moving on to the next one. Speaking of Convex, this is a critical one to the rest of the Badger strategies that we'll be talking about. So the next one is Convex Vote Locked CVX. So what is going on in this one?
Amazing. So we got the Voldlock CVX, which effectively, what is Convex, right? What is CVX? CVX is the governance token for Convex.finance. It ultimately, Convex.finance is a set of smart contracts that are meant to gain as much locked curve as possible. And to the point that their own token, CVX, the emissions of that token are modeled based on the amount of curve that the protocol is controlling. And so you'll see that the more curve and the more CVX curve is minted, the more CVX ends up being minted, which is an interesting tokenomic. It's basically CVX is all in curve. That's what it means. And so what they were able to do is they were able to amass a huge stack of locked curve, which is called vested escrow curve. It can also be referred as VE curve or VE. You may see a contract called vested escrow or a contract called VE dot pi because they write it in Viper, so dot Viper. So by what they did again is they amassed a big stack of CVA of curve, and so the next step that Convex took is that they allowed locking of their own token, the locking of CVX, with the goal of voting where this curve goes. So by locking CVX, Badger and the depositors, they are able to determine where these curve votes will go. This has introduced the dynamic of bribes, and it basically also introduces the dynamic of yield influence. Ultimately, the ability of having a lot of curve allows to vote where more curve goes, and so it effectively allows to decide where some of the yields in DeFi will go. And what we did in order to gain a piece of that pie is, instead of buying CVX, we created a vault called the Badger Vested Escrow CVX, which was the first in the industry. We literally did the audit or the, let's call it, the security contest for the code in partnership with Convex, in partnership with their lead developer C2. And so our vault effectively takes CVX, the governance token for Convex, and it then locks it and then delegates the voting power to a multisig that is controlled by the Badger DAO, with the goal of maximizing ecosystem Bitcoin yields. So all the pools we can raise the APYs, we will. And at the same time, with the goal of providing further utility to tokenize Bitcoin. And the best example would be the Imbtc pool, which is highly incentivized thanks to the locked CVX.
All right. So to sum this up, most of the yields on Bitcoin and many other assets in DeFi come from Curve CRV token emissions. Where do those come from? Well, if you have Curve tokens, vote locked curve, or vested escrow curve, sorry, you can then vote on where they go. And Convex came along and created their own flywheel that got people to deposit their Curve voting power. And so now much of the Curve voting power is controlled by Convex. And so in order to be able to vote for yields on Bitcoin related assets or some other things that we'll talk about in a minute, we, instead of buying the CVX for ourselves, we created this vault that incentivizes users to deposit their CVX with us, which gives us the voting power, which enables us to create the yields on Imbtc or Btc, some of the other Bitcoin flavors above. So this vault is saying you can deposit your Convex on Badger, and for people that deposit, what is the reward of mix? The mix of rewards that they're going to be getting for that.
Yeah, ultimately, locking CVX does provide a set of boosted rewards from the native Convex platform. So you're going to get an additional portion of revenue from Convex, as well as the usual emission from staked Convex. So you can look at locking CVX from a purely economical standpoint as the act of staking for a forced period of time, because the rewards are similar with a little extra percentage from the again the profits from the Convex platform. And then on top of that, Badger also adds their own emissions to incentivize it. So if you look at the current math that I'm seeing, it will be 2/3 in rewards from Convex, and then there's an additional third of bonus emissions that are from Badger.
Got it. Now, maybe this is a good time to address the BVE thing. So if someone is familiar with Convex, CVX, they're putting their CVX in this vault. But then what is this BVE CVX and the BCVX CRV rewards? What does the B come from?
Yeah, ultimately, when you name a token, you want to give it a short name. So the convention that we use at Badger is that any vault, any set, or basically any of our yield aggregation products is going to have a token. and that token is going to be named with a beginning lowercase b. So that's just the convention. So when it comes to what BVE CVX is, it's basically the Badger vested escrow CVX vault. It receives CVX and then it locks CVX for you. And so you can look at BVE CVX as the token representing the locked CVX in the vault. And because of how we wrote the vault, the exchange rate between the BVE CVX, the share token, and CVX, the underlying token, is always 1-to-1, which means that you always get back one CVX that you deposited. Um, and effectively, the share just represents the ownership on the underlying. So from a technical standpoint, there's nothing special about BVE CVX. It's just a token representing your ownership of the pool. And from a practical point of view and an economical point of view, BVCVX basically represents locked CVX that is still tradable, is still movable, is still usable. And that's why, and we'll talk about probably next, but that's why we also have a pool that allows you to swap in and out of CVX and BVCVX to provide that additional flexibility and that extra optionality.
Got it. And I think maybe one other interesting thing about this is you see the BVE CVX rewards. So you're getting more tokens of the same vault as a reward for that. And some of that, like you said, is coming right from Convex. But recently, some of it has also come in the form of selling bribes that Badger votes for. So this is kind of a new mechanic in this vault. Can you explain how that works?
Yeah. So as we introduced before, the curve, it's called the curve wars, but ultimately the mechanism that curve developed of vested escrow, which by the way has an emission schedule of over 100 years. Curve is effectively an inflationary tokens where the inflations are voted on by the token holders. And arguably is one of the most brilliant tokenomic play or game we play in DeFi. It's a really interesting mechanic. But at the end of the day, the mechanic simply means that people are voting where these new curve emissions will go. And so when it comes to how we get, or sorry, when it comes to the rewards, um, the curve emissions are so precious. They're so useful to certain protocols, including Badger, other protocols being Spell, which is Abracadabra the money, or Fraxes, and even Convex itself. These curve emissions are so precious in motivating people because ultimately liquidity mining campaigns have proved to be extremely useful in getting liquidity to new assets. And so they are so sought after that this entire dynamic of bribing came to be. The original bribing contract, I believe, was written by Andre Cronje himself, and it was the ability to bribe for voting via the vested escrow curve token. So the native curve, in locking it, you will get this V curve, and again, you will get bribes at that level. And then on top of that, once locked CVX was introduced, a new protocol called Vodium was created, where other protocols can bribe votes from the Convex vote. So you're basically taking locked CVX as a CVX locker, and then instead of voting whatever you want, you're going to delegate those votes to Vodium. And in doing so, you're going to be able to collect a bunch of bribes. If your CVX stack is big enough, you could actually just sell bribes yourself. You can literally go on Twitter and treat it as a trade chat and just sell bribes on Twitter. But ultimately, the reason why this happens is because the emissions in Curve, basically the emission in underlying APY, are actually higher than the cost of the bribes. And that's why this is even doable. And in the case of Badger, I believe this week or these 2 weeks, because that's the schedule for bribes. But basically, this week we actually experimented with using a little bit of our voting power to gain a little bit extra bribes, with the goal of emitting them back. If you were to check our BVCVX smart contract, you'll see that we have a set of functions that allow to claim the bribes, and the bribes are instantly emitted back to the community. Again, with the goal of just redistributing them through the Badger tree.
Got it. So some of the CVX that is coming from rewards is coming from these bribes that are then sold and put back into CVX. You've also got Badger rewards, which I think the goal is to keep that at a steady 15%. So it kind of auto adjusts based on the price of Badger and Convex relative to each other. And then finally, you're getting Badger CVX CRV. So based on what you said earlier, I assume that means that the CVX CRV token is going in a Badger vault also.
Yes, exactly. Every time you see B in front of a token when talking about Badger, it means that it's our vault token.
Got it. I think the last thing maybe to touch on this is the locking mechanic, because it says vote locked. And what is the ability to get in and out based on this locking?
Yeah. So as first of all, I highly recommend the listener to try the technology, to go and try it, and go try Lock CVX, go try Vested Escrow Curve, and go try our BV CVX Vault. Ultimately, if you try and lock Curve, that's a one-way operation for a certain period of time. It goes from a few months to 4 years. Similarly, for locking CVX, that's a irreversible operation that lasts for 16 weeks. So if you lock your CVX, you have to wait 16 weeks before you can claim it back. And when it comes to Badger, the way we handle that, because again, we receive this liquid CVX token, and then our underlying token is the locked one. We basically handle that by allowing to redeem as much as possible. So any liquid CVX we have, the vault will let you withdraw, which lends itself to arbitrage opportunity for the acute listener. And then the for the rest, every time a lock expires, basically on a 16-week schedule, we're gonna then release these locks. As you can imagine, each week we're gonna be locking more stuff, locking more CVX. So what happens is that after the 16 weeks, which already passed, by the way, we're basically at week 17 or week 18 now. We're gonna have to start. We're gonna start to have progressive unlocking, where each week there's going to be a few 100,000 CVX claimable. And then at the beginning of the next week, we're going to be relocking them. The way we stagger the locking and unlocking mechanism, or the relocking and unlocking mechanism, is that we unlock on either a Thursday or a Friday, typically Friday at latest. And then we're going to be relocking on the last minute or the last 3 minutes of a Wednesday. That's because we literally give as much time as possible to give a withdrawal window for people that want. And then we need to relock before Thursday because that's the time for where the snapshot happens for votes on the Convex governance snapshot.
Got it. So I think the important thing is that there are every week some portion of this vault is unlocking. So it is possible that someone could deposit, and if they're a large depositor and then the next week they want to withdraw, there could not be enough. There may not be enough for them to withdraw. So there is a dashboard, which I guess we can link here, that shows the unlocking schedule for Convex. So
yeah, if you Google Dune Convex vote locked, you should be able to find it. You can type Convex locked CVX on Dune.xyz, and you should be able to find both the weekly unlocks as well as the unlocks for the Badger Vested Escrow Vault. So feel free to ask on the Discord as well. It's one of the most beautiful visualizations we have, and it really shows how the vault works.
Yep. So they're getting locked for 16-week periods, and then after that they unlock. So it like what is unlocking in a given week is determined by 16 weeks ago, right? It's not and it's also what's available based on the supply and demand of other withdrawers. So if you are eager to withdraw at a certain time, just take a look at that dashboard, and that will give you an idea of when you have the best ability to withdraw.
Yeah, absolutely.
All right, let's go to the next one, Convex CVX CRV. So we touched on this a little bit earlier because it's a reward of the other two vaults that we've discussed, the Ibbtc LP and the VE BVE CVX. So what's happening in this vault?
Yeah. Uh, Basically, this is a another convex staking vault where we take the underlying asset, which is uh, in this case it's CVX CRV, so it's already convex locked curve, which is an irreversible operation. And then we basically stake it in the Convex platform to receive rewards and emissions from it. The reason why this is a called also a helper vault is because other vaults that may be doing a different strategy where they're staking a LP token, they're going to end up receiving a few CVX curve as rewards. And so what they're going to do is they're going to stake it or redeposit it back into this helper vault and then emit it to our users. That way, the end user get a continuously compounding token instead of a token that is not compounding and not staked.
Got it. So the advantage of either depositing onto this vault or keeping your rewards from the other vaults in this Badger vault is that rather than having to claim and deposit back in, it's saving you the gas of auto claiming and compounding it back into that vault, right?
Yeah, and I would say that's the one thing that I've heard about Convex is that you can't auto compound. You have to claim, and then do it yourself. That's what the Alper vault does. It claims and it auto compounds for you, and then other vaults also emit this token as a way to make sure that whatever you receive is always earning interest.
Got it. All right. Did we miss anything on this one?
No, ultimately, the interesting thing about our conversation is that it was front loaded, and then now we can go through a few of these vaults. But ultimately, we covered some of the basic dynamics, and you'll see that there's a lot of overlap in most others.
All right. So next, this is the one I was going to before because it is deeply connected to the Badger vote locked convex vault. So this curve CVX slash vote lock CVX vault. What's the purpose of this vault?
Yeah, ultimately, this is another LP curve LP vault. It's just like the Ibbtc SBTC LP curve LP vault. Basically, you're staking your CVX slash vote lock CVX curve LP token in this vault, and then we are going to be staking that in actually, we don't have a gauge for this one, so we're just gonna be emitting rewards for you. It's literally like a very old school master chef like approach, where ultimately we ask you to go on curve, provide liquidity either via CVX or via BVE CVX, and then or a mixture of them, and then just stake that LP token in the Badger website. And the reason why we want that is because that way depositors of the BVE CVX of the vote lock CVX vault have an opportunity for an early withdrawal. As we said, BVCVX is liquid at 16 weeks intervals. That may be staggered by 1 week, so it could end up being extremely liquid every week. But there's still the amount of withdrawals that can happen in a given week is going to be limited. And so a way to bolster that is to have a curve pool that allows you to swap out of it. As you can imagine, you may be taking a discount, if I'm not mistaken, during the top of the bull market for CVX when CVX was hitting $50. I think the pool was imbalanced by maybe 5% at most. But you may be taking a discount for the privilege of exiting the exiting the vault early and going back to a more liquid asset, which is CVX. So this is the goal of the pool, is to provide early liquidity for people that want to leave. And at the same time, if you look at it the opposite way, one vote lock CVX is always going to be redeemable for one CVX. It's just a matter of time. So for people that want to support Badger, they can actually purchase BV CVX at a discount through the pool, through the opposite dynamic.
Got it. So as we discussed before, the vote lock convex is locking, and if you want to get out early, you can swap your vote locked for regular in the curve pool, and the URL for that is curve.fi/factory/52. So you can see that. And I guess the one thing to point out here is that right now I'm looking at this, and this changes, every day, but it looks like there are 32,700 CVX in the pool and 28,400 BVE CVX. So uh, there's not unlimited liquidity, right? So in the vote locked convex, I think there's over 1 million convex tokens, but in this curve pool, there are 32,000. So it is not, if you're a whale that has 100K CVX, it's not going to be enough to get out, and you'll have to wait for the unlock, right? So it's important to keep in mind that the exit liquidity for the locked convex is not maybe whale sized.
Yeah, and it's just an indicator of the interest. I know every time CVX gets unlocked, there are people running arbitrages, but my just looking at the chain tells me that there are people that understands that this is more of a vision thing. We're building an ecosystem, so it's not just a matter of the specific vault, but a matter of the combination and the how the protocol can grow. Versus the ability of exiting early, which obviously incurs a penalty in a sense because it's just a very illiquid market. And those tokens, VE curve is so illiquid you can't trade it. The same goes for locked CVX. It's so illiquid you literally cannot even trade it. It's just a balance in your wallet, but you cannot move it. So Badger vested escrow CVX, PV CVX, addresses that by being a ERC20 that you can actually trade.
Got it. So this pool would be for someone that maybe they're aligned with Badger. They believe in the mission of having BVE CVX because it supports yields and DeFi, and they're happy to provide liquidity on Curve to allow people to swap in between. And in reward, they're getting a mix of rewards that's mostly the Badger token as a reward, but some LP fees from Curve.
Yeah, they're mostly getting emissions, and then obviously if you're long Badger vested escrow CVX, every time you sell some CVX for BV CVX, you basically get the locked token, which eventually is redeemable for one CVX as well. So I would argue it's a good long Badger, long CVX strategy. And so if you're really bullish in these projects long term, getting a free 5% bonus on your locked CVX is more interesting to you than the exit liquidity early to play more momentum games. So I definitely think it's a different take on it's just a different strategy based on a different long-term view compared to a shorter swingier short-term view.
Got it. All right, let's move on to the next one. So this is the Badger Dig LP strategy. What's going on there?
All right, for Badger Dig, I believe this is just a staking vault that effectively just receives emissions from Badger. So you're being rewarded for holding Dig, and you're being rewarded in Badger emissions for it. So there's nothing out of the ordinary there. It's just a historical way to incentivize Dig.
But it's I'm looking at the strategy. It's not Badger emissions, it's Dig emissions, right? So it's vault compounding. So you're staking your Dig and getting more Dig auto compounded, right?
Yeah, you're right. It's emitted as Dig. So effectively, whatever share you put in, you're going to get a bunch of shares. And then over time, they're going to appreciate to allow you to withdraw more Dig um, compared to the amount you deposited.
And as we talked about before, when you're depositing in this vault, you're going to get a token called Bdig, which is represents your staked Dig in this contract, and the ratio of Dig to Bdig changes over time as more Dig is added to the underlying vault, right?
Yes, and the beauty of the Badger app is you can go in the vault and you can click on the default tab is called set value, which is the dollar value. But if you go on token ratio, you'll see that over time the BDIG ratio increases. So you can really see how your share token, the BDIG, how it increases in value because it allows to redeem more underlying.
All right. The next vault I'm seeing is the Sushi Swap WBTC slash IBBTC vault. And this looks like a vault that is providing uh, rewards, or you're getting LP fees on Sushi for staking your LP token that allows people to swap between wrapped Bitcoin and interest bearing Bitcoin on Sushi.
Yeah, sushi swap strategies used to be extremely popular, especially in 2020, 2021. With forks and sidechains, MasterChef has been the biggest staking contract on Earth. It was the most popular, the most used. And Ultimately, a MasterChef strategy, which is the one used here, will simply take the LP token, stake it in the MasterChef, and then claim rewards on your behalf to auto compound them. So that's what the sushi swap strategies will do. In this case, this specific strategy is yielding less than 1%. So I believe there are no longer sushi emissions there. But the gist of it is always the same. You just stake it in the master chef and you claim the sushi rewards.
Yep. And there used to be also Badger emissions on this, but now we've moved our LP to Curve. So most of the, or all of the Badger emissions that used to be going here are now going to the Curve LP. So I don't know. Is there any reason why a user would want to use this one as opposed to the Curve LP?
Yeah, I can speak to that, and I can definitely see a specific user that is security focused. They may not be as familiar with Curve. They may not understand it. They may believe it's not as safe, and so I think if you prefer a more battle tested smart contract that hasn't changed in 2 years, the Uni V2, which is the fork of Sushi, what Sushi forked. Is I would say it has a more understandable security profile. And also, economically speaking, while it is less capital efficient, there is an argument to be made for using a sushi or a univichu like contract for LPing because the math is easier to calculate your impermanent loss, your risk, and the fees you're going to get. So I can see a specific, very savvy user making the conscious decision of using this one. If you but as the savvy user, I would still recommend you go and check the curves logic because of the increased capital efficiency and also the boosted rewards you're going to get by staking it through Badger.
All right, moving on. Another Sushi Swap vault, the WBTC Badger vault. So I assume this is also giving rewards for staking your Sushi LP token. Um, that if you're providing liquidity on Sushi, which is like the Uni V2 style liquidity across the full range between WBTC and Badger. So what's happening in this vault?
Yeah, this vault has a very similar strategy where you end up depositing the LP token. And then through the LP token, you're going to gain trading fees. And that's a de facto standard of every AMM, and then you're also gonna get Badger rewards. I also believe the sushi, the Master Chef here also no longer emits sushi, but I believe it used to as well incentivize liquidity that way by emitting sushi as well and auto compounding it for more underlying.
All right, and also we at Badger have moved most of our liquidity away from this model of paying a lot of Badger rewards to people for providing liquidity to providing liquidity on Uni V3 based on funds in Badger's own treasury. So I don't know. Can you kind of comment on that? Is this is like kind of generally a move away from these paying people for LPing on sushi strategies, right?
Yeah, I'd say that liquidity incentives may be the best marketing ever created, and I think they may still be. uh, you can just think about the most recent I guess in this case it will be some phantom shenanigans, but basically most of us will be tempted to bridge because of these incredible APYs. And so if you met Badger when it launched, you probably were intrigued by the astronomical APYs as well, just like with any other protocols. It could be Sushi, it could be Curve, it could be all of these. The problem is, longer term, they don't help to create a sustainable business. So they're completely fine to bootstrap attention. They're great to get attention and kickstart the momentum needed to even make it, to even have a chance. But ultimately, they are unsustainable. And so, a more sustainable perspective would be for protocols to own their own liquidity, which is what Home popularized, the idea of treasury on liquidity or protocol on liquidity. And so, personally, I think that if the DAO is its biggest customer, we will get a better product market fit in our products because they're going to be used, and they're going to be used because they actually work instead of them being used because they're incentivized. So I think that's really important to keep in mind. And then the other side is that if you are your own customer, then that also reduces risk in terms of determining whether strategy will be successful or not. Investing weeks or months and audits, hundreds of thousands of dollars, tens of people's eyes to get some code that nobody will use. So reducing that type of risk in knowing what is going to work also can be extremely helpful. And ultimately, the DAO also wants to keep its treasury active as to hedge against market downturns. Being able to maintain a lifespan. The DAO not dying, and then at the same time, just more resources don't hurt. It's a good idea to keep those assets productive.
Got it. And it looks like there are still some Badger emissions on this vault. So, and a good amount, 14 million or so of liquidity on Sushi. So, would you anticipate that there's still going to be some, albeit less, LP on Sushi going forward, even though it's mainly on UniV3 now?
So I would say that I think a healthy balance between the three is probably ideal. The three being Univ free, Sushi, and Curve, and based on that, it basically will be decided. If you want my personal opinion, I'm happy to share it, and it's that I think we should not incentivize any liquidity unless we're basically buying it with our own token. Those are my true cents. If we're basically trading Badger for something else, then yeah, go ahead and incentivize. But if you're just renting the liquidity, I don't see it useful. And so I can go on the record saying that, like, I think the Yearn model of just never giving anything, just just have no emissions and just dump everybody else's token. I'm not gonna say it's a winning strategy, because maybe there is better. Maybe the curve model will win, or a collaborative model will win even further. But ultimately, it's proven to be a valid model where you just ignore liquidity, ignore people that are just trying to get the extra APY, and you just focus on product market fit. So if you ask me which type of strategy I would want to build, are strategies that are standing on their own. They don't need extra rewards. So those are my 2 cents. But as the depositor, as the user of these protocols, uh, you just gotta balance out the impermanent loss, because Sushi will offer a different profile of impermanent loss because it's a more generalized range against a more specific range on Univ free, against a more math heavy approach on Curve V2, which is they are very different math profiles in terms of how to understand the how to make it work and how to make it profitable. And I think that's ultimately to the end user. And I don't think there's a one solution that fits everybody.
Okay, next up we have the Sushi Wbtc Dig, and this is very similar to what we just talked about with the Wbtc Badger. So this is just incentivizing liquidity for Dig on Sushi.
Yeah. The interesting thing though about the WBTC Badger one is that if you look at the fees, the APYs, it still shows a really healthy 14% LP fees, right? Like it shows that it probably is used maybe 60, 70% liquidity utilization. And the volumes are also pretty decent considering that APY. So that's a pair that is standing on its own, right? And you also get the emissions on top of it, which is always nice. And then this one instead, the Sushi Swap WBTC Dig, is basically subsidized by emissions. And so its APY is mostly a function of liquidity, and it works in a very similar way where you again we used to stake it in the master chef and then also auto compound the sushi rewards, but at this point you can consider it more of a staking vault where you're staking your sushi LP for badger emissions, in this case dig rewards.
Yep. And I think maybe the other thing to comment on is kind of the future prospects of this, right? Because with Uni v3, a dig is not supported because dig is a rebasing token, right? So there's not really a path to moving this off of Sushi at this time. I'm not sure about Curve. Do you know if is there any potential to move this to Curve v2?
I believe Curve also doesn't support rebasing assets because they cache their own balances in the storage of the contract. There is a pool that is being worked on, I believe, by the Fay team to allow for rebasing assets or assets that change in price. And if we can get that on Curve, we will be using that as well for the Bbtc. So ultimately, it's a good technological improvement. But to be honest, on a risk profile, on a more economic perspective, I wouldn't discount the UniV2 model. Like the UniV2 model is more generic, but I wouldn't say it's worse. It's just a different way of LPing. So I don't think we will ever get rid of this x times y equals k formula. A very simple curve, because it actually provides its own utility in being a little more generic, in being a little less efficient, but in allowing quite literally to price anything instantly instead of having to swing trade and check for an oracle and have to be seeded, etc. You can make the argument that it allows to reach consensus on price more cleanly without being pushed through external pushes such as an oracle or something like that. So I don't expect UniVichu to disappear ever. I think it will be part of the future.
All right, next up we have the Stable Imbtc vault. So this is a newer vault, and I'm not super familiar with it. So what's going on in this strategy?
Yeah. So first of all, Mstable definitely has got to be the most interesting tokenized Bitcoin protocol after us. Like I think they really try to solve the fundamental issue of creating a diverse basket of underlying tokens. In the case of Mbtc, they offer you to mint Mbtc with multiple tokenized Bitcoin, similarly to our Curve will allow you to mint the LP token for rank curve or SBTC curve through SBTC or MBTC and WBTC. And the twist that they added is they actually tried to add a yield bearing aspect in it, right? So you basically have MBTC, which is the unstable Bitcoin, which is a basket of assets, and then you have the Imbtc, which is the interest bearing version of MBTC. And the way they earn interest is they have a AMM that allows you to swap different Bitcoins, and they basically use those fees as a way to offer additional yield. So if you look at it from a different perspective, what Mstable did is they created a basket and they tokenized that basket, they productized that basket, and then they used that basket as the foundational liquidity for an AMM that allows to swap within those assets in order to gain yield on it. So it's kind of the Curve and IBBTC mixed together. And so I think it's a really interesting experiment they did. And so I highly recommend you go check out their code and the resources. And this was done in partnership with them. And specifically, there is an additional partnership component where Mstable used to land some of their MTA, their governance token, in order to allow the strategy here on these vaults to gain additional boosted Mstable rewards. So this was I say was because I believe the boost on MTA is finished now. However, there's still emissions and still a fairly strong APY offered from these vaults. And interestingly enough, most of it are from the MTA rewards. And then again, this underlying appreciation of the asset because the asset is actually interest bearing as well.
All right. Next up, we have Stable Mhbtc. This is another Stable partner vault.
Yeah, this is a twist on this is a twist on the Imbtc, and it's effectively a staking vault for the liquidity pair called Mhbtc, which is basically the M stable BTC pair with the Huobi BTC token. So this is effectively similar to a MasterChef staking vault, with the difference that we are staking in a M-stable coded smart contract called the feeder pool. But is effectively very similar. You're staking this MHBTC that you gain after providing liquidity in the MBTC HBTC feeder pool, and then you just stake it to gain additional governance token rewards in the form of MTA, which I believe are auto compounded in this case.
All right, next up we have the Convex Try Crypto 2 vault. So this is looks like another Curve LP token vault that's going through Convex.
Yeah, exactly. Anytime we use we type in Convex and then you see a Curve token, that's basically the strategy. In this case, you're gonna LP on the Try Crypto, which is Wbtc, ETH, and USDT. And then you can deposit that LP token in the Badger Vault, and then the Badger Vault is going to invest it and auto compound it for you through the Convex system.
And I'm curious about this Try Crypto token. So that's kind of what, like, you can deposit either USDT, the stable coin, or WBTC or ETH, and then it's going to give you this LP token. And what is the price exposure of that? Is it kind of like a blend of the stable plus the BTC and ETH price? So
Amazing. This is an amazing question, and maybe we want to dissect it in the future as well. But I'll give you my 30-second answer: is you are taking market beta, two-third market beta, and then you're taking a little bit of alpha on the long short of WBTC and ETH. That's because arguably ETH is a lower cap asset, so it has a little bit more risk, but arguably it also has a little bit more alpha. It goes a little bit higher than BTC, and BTC is a little more of a sponge in terms of volatility and security in general. It provides a little less volatility compared to other assets. And then obviously you have the stablecoin part, which does nothing. It just stays stable. So funnily enough, some people may believe that LPing in Try Crypto means you never lose money. That's not correct. If you deposit $1 of USDT in Try Crypto, and both BTC and ETH go down, or just BTC goes down, you can get back less than $1. So it is not a stable coin. It is not a stable pool, but you can see it effectively as, in a way, buying the index with a little bit of an edge, a third of stable that gives you that edge. And then you get a very strong amount of rewards as well. So the way I see it is it's if you're long the ecosystem and you don't mind the volatility and you like the rewards as well, it may be one of the best pools in general because you just set it and forget it. You don't think about it. It has the market beta, so it will go down when the market goes down, and it's gonna go less up when the new stablecoin goes to 1,000,000x. It's gonna go less up, but at the same time, it really captures cryptocurrencies as they are in a way. It's a pretty decent index, and it has very interesting rewards as well.
yes, so just to go over, it's boosted Badger. So Badger is continuing to pretty heavily incentivize this with its own governance token. Curve LP fees, it looks like almost 3% when I'm looking at it now, which is pretty good for Curve LP. And then you're also getting the CVX CRV and BVE CVX rewards on top, which go into the auto compounding vaults that we discussed above.
Yeah, I'd say honestly, I'm just doing head math, so don't quote me on the math, but 10%, 15% APY without booster rewards on something that is taking a further less impermanent loss than average on a stable pair, on a pair that is fairly market beta heavy. So it's not like you're not taking an insane trade here. I think it's really rare. I've very rarely seen something like that. So I really like Try Crypto in general. I think it's a really interesting technology, and it also is a really interesting um, uh, reward compared to the risk it offers.
Okay, next up is the Convex Ren Wbtc SBTC vault.
Yeah, so this will be the SBTC curve pool. Basically, this is the counterparty to the Imbtc curve BTC LP. And this vault allows you to take the curve LP token and then it's going to stake it for you on Convex. Currently, the emissions are very low. So you see a 0.90% APY, at least that's what I'm seeing. But effectively, this is just like all the other strategies, taking the Curve LP token, going on Convex, and then staking it, and then auto compounding those rewards and emitting the ones that make sense, such as BCVX and BCVX Curve.
Yep. And the reason that the Convex and Curve rewards are so low is basically because no one is voting for them on Convex. Someone could, or Badger could in the future, but right now no one is doing that. So it's not getting any Convex or Curve, or very little Convex and Curve rewards, right?
Yeah, we may do a chat about IBBTC, but suffice to say, I'm actually a big fan of the SBTC Curve LP token because it's the counterparty to IBBTC. So I believe it should be more used than the RAN one, but currently it is not. So let the market do its thing.
Okay, next up, Convex Ren BTC Wbtc vault.
Yeah, this is effectively the same idea as the SBTC one. You can LP or deposit RAN or WBTC in the RAN BTC curve pool to get the RAN BTC curve LP token. And then again, we're going to stake it and auto compound and emit rewards through Convex. So it's basically a very similar strategy.
And there are not any current Badger rewards on this. And in addition, there seems to be fairly low APY from Curve and Convex. And that's just because of the voting strategy now that no one is voting heavily for that in Convex.
Yeah, you can also see though that the TVL is almost 3x the ones from SBTC. So arguably the APYs will be literally the same because if you divide it by 3, it's basically close to it, maybe slightly less. But yeah, I would be a fan of consolidating the RMBTC and SBTC pools into the SBTC pool because it's basically the same. It's just for historical reasons and maybe for a little bit of trust. People don't like SBTC as much. SBTC being the synthetics BTC tokenized Bitcoin.
Okay, next up, we've got the Convex TBTC/SBTC vault.
Yeah, similarly, this is again staking in Convex, the LP token that you will get from providing liquidity to the TBTC SBTC pool on Curve, which again you can achieve by using TBTC from Rook and SBTC from Synthetics.
And just like the others, no current Badger emissions on this, and fairly low APY because Badger is using its Convex to vote for Imbtc and Ren at this moment.
Yep.
All right, next up, Convex Hbtc vault.
Yeah, this will be the Wbtc pool. I believe its counterparty is Wbtc. Yeah, Wbtc. So this is just a pool with HBTC and Wbtc. And again, we're going to take the LP token and then stake it on Convex and then auto compound and emit the rewards.
Okay, next up, we have the Convex Pbtc vault.
Yep, the Pbtc vault, similarly to the other vaults for Curve and Convex, will take the Curve LP token. In this case, it's going to be a meta pool between the P token BTC, PBTC, and the SBTC pool. And then once you have the LP token, you can deposit it in the vault, and then the vault will stake it on Convex and harvest the rewards, auto compounds a few of them, and emit the others.
And it looks like this one does not have vault compounding. Is that just because of a rounding issue, or it's not showing up there?
I would assume so. Yeah, I believe all partner vaults have a 20% compounding ratio.
Next up, we have the Convex Obtc vault.
Yep. Similarly, this one is with the borrowing DAO BTC, and the counterparty liquidity is the SBTC. So it's similar to the previous one, to PBTC. And again, you can deposit the Curve LP token in the vault, and then the vault is going to stake it on Convex and harvest the rewards and emit a few and auto compound some others.
Next up, we have the Convex Bbtc vault.
This one is for the Binance Wbtc vault. It's basically Binance Wbtc. The other side of the pool is also SBTC, the SBTC Curve pool. And once you have the LP token from Curve, you can deposit this in the pool, and we'll be staking it on Convex, harvesting the rewards and emitting a few.
All right, so that does it for the Convex vault. Now we get to the Convex CVX vault, or this the deposit token is the BCVX vault. So how does this differ from the vote lock Convex?
Yeah, this is a BCVX, or a CVX helper, or Convex CVX. And effectively, this is a staking vault for Convex. So the way Convex works, or used to work, is they wanted you to own some CVX, and they wanted you to hold some of the CVX. And in order to incentivize that, they would reward stakers with a little bit of platform fees. So that was the idea, and the platform fees were obviously emitted in CVX to incentivize holding more CVX. That's what is still going on, and that's what the helper CVX Vault does. The difference is that more rewards are being funneled to BVE CVX, the locked version, against the staked version. The reason is simple: the locked version has a little bit more risk, and so you want to be incentivized to take that extra risk. The risk being the fact that now you're locked in CVX for 16 weeks. And so that's kind of the risk profile. The BCVX, this one, allows instant liquidity at any time. There's no denying the liquidity, while the lock CVX is a little bit riskier because liquidity can end, and you would have to wait for the 16 weeks unlock period.
All right, so next up, we have the Yearn Wbtc vault, which is probably one of the more interesting vaults because it has this multi-strategy approach, even though at the current time it's not yielding more than 1%. So what's going on with this one?
Yeah, I'd say we've spoke about this in the Wasabi boat podcast. This is actually how we met, and I'm happy to talk about it perhaps at a different time in further detail. But ultimately, the Yearn WBTC is kind of a basket of strategies. So it takes WBTC, the tokenized wrapped Bitcoin, and then it uses a mixture of various set of different strategies. I believe upwards of 10 to 12, and typically 3 to 5 very solid strategies, some of them being convex, some of them being curved, some of them being on compound, others on Aave, which I helped write, and then some others on the new protocols, Vesper Finance being one of them that comes to mind. But ultimately, it through trying different strategies, it tries to achieve the best yield. As you're aware, Yearn does not emit anything, and so that's why I personally explain the yield as being at that level. Is the mixture of lacking emissions and then the fee that Yearn takes, which I believe is 2% management, 20% performance. I believe is split, if I'm not mistaken, 35% for Badger and the rest to Yearn. But ultimately, it's just the incredible TVL that they're managing, which may be $1 billion in Bitcoin. I know it was at least 600 million. And so when you're dealing with that high of a TVL, yields start to go down unless you also emit or you incentivize them more heavily. So on a risk adjusted basis, it's a pretty good strategy. From a technical standpoint, it's one of the most interesting ones. And if you're a developer, you definitely want to check it. From an end user standpoint, it's offering a little bit not as a high return for the risk that you are taking.
All right. And next we have the Sushi Swap Wbtc WETH pool.
Yeah, this is similar to the other Sushi Swap strats. It's a staking vault where we stake the LP token in a master chef. The master chef, as with many others, has already expired, so it means that there's no longer more sushi emissions being added. However, interestingly enough, the pair still has about 6% APY, so you can see that it is a fairly traded pair considering its liquidity, which I believe is pretty high.
And that's likely because WETH is such a common trading pair in DeFi, right? So a lot of other trades are getting routed through this pool.
Yep, for sure.
All right. And finally, last one on Ethereum, we have the Uniswap Wbtc Badger pool, which I assume is basically analogous to the pool on SushiSwap, right? It's a V2 pool.
Yeah, this is the pool chew, the classic pool chew. Badger, being aligned with Bitcoin, decided to use a BTC route for its pool chew, but this is effectively the one of the probably the second most liquid trade you can make with Badger. The most liquid being the one on Sushi, but it's ultimately a LP pair that allows Badger to be more liquid. And so at the time it was incentivized. At this point it is not, but it's still yielding 16% fees. And you can see that I would assume that its utilization ratio compared to TVL is pretty high. 16% APY on a liquidity position is typically really good, especially for mainnet.
All right, we've made it through all of the Ethereum Badger Vault. Alex, thanks so much. I know you have to run to a meeting now, so we're going to leave it here, but hopefully we can another round of this where we talk about Arbitrum and all the other L2 strategies that we have. And before you go, please do leave us a comment, rating, review. It helps other people find the podcast. And make sure you subscribe so you get future episodes of the Badgercast. Thanks, and we'll be back with you soon.